Hi, let's talk a little bit about hot stocks, actually probably the hottest stocks in recent years, and I'm talking about the Magnificent Seven. So what is this Magnificent Seven all about? Those are the seven biggest company from USA. Together, those seven companies are around 27% of the S&P 500 index. So let me explain how big they are. The S&P 500 index is an index that combines together 500 biggest companies from the USA. And those seven companies, they are around 27% of that whole index. So out of 500 companies, the top seven companies are 1/4 of the whole thing. So it's really, really huge disproportion that when you want to invest in 500 stocks from this index, you're really investing majority of your money just in those seven stocks. Those stocks are Apple, Amazon, Google, Meta, so Facebook, Instagram, Microsoft, Nvidia, and Tesla. What's the big problem that I can see in Magnificent Seven? All of those companies have very high prices compared to their earnings. So in the short term, the price of the stock can go up or down based on some news, positive news, or based maybe on some hype around the stocks. But in the long term, so thinking more about a few years ahead, the amount of money you can get from the investment is strictly correlated to the amount of the real cash that the real company produces. So in the short term, the price of the stock can be far beyond the real value of the business. But if you are trying to hold those stocks or this S&P 500 index for long term, that price will eventually reflect the real value of the underlying businesses. So the PE ratio of Magnificent Seven, let me explain the PE just in a second, is a financial indicator that tells you for how many years the company has to work and produce cash in order to pay back the price you paid for the stock. So if the stock price is 100 and the company makes $50 per year per one stock, then it will have PE of 2 because it takes 2 years in order to generate that amount of money. So if you bought that company in reality, it will take 2 years to double your money. And Magnificent Seven has the PE ratio of 45. So with the earnings stable, it will take 45 years for you to double your money in reality. Stock price in the next day, in the next month, can go up or down based on many different factors. But if you look at the stock market long term, if you're a long-term investor, you can really expect to earn as much as the companies really make compared to their stock price. So why does those companies have such a high PE ratios? It's because of the speculation that those companies, because of the artificial intelligence, etc., will grow their earnings very rapidly in the future. And it's also because of the optimism that can be seen on the stock market. So the PE ratio of the top 7 companies in USA, 7 biggest companies in USA, are usually around 20 to 35. If we look at the chart from 2015 to 2024. But nowadays, the current PE ratio is very high. It was so high only twice in the end of 2020 and in 2022. If we look at the forward price to earnings ratios, so those are the ratios that look also at the growth of the stock, we see that those ratios are also not so good for a lot of those stocks. Of course, it depends on who you ask, but for me, Nvidia has current PE of 66, but accounting for growth, the forward PE is 32. So to some investors, that might be not such a bad indicator, but for me personally, 32 years to double your money, I'm sorry, but in reality, it's not that great. And of course, maybe in reality, the artificial intelligence will be such a great revolution that it will bring the earnings of those companies much higher. But for me, buying something with such a high PE is just not a comfortable bet. And I can see the very optimistic sentiment of investors nowadays, and I see a great danger, especially among the people who don't know what they are doing. They are just speculating, gambling on the stock market. The highest PE ratios are for Amazon, that's current 59, and for Nvidia, that's 66. The forward PE ratios of Amazon is 41, and of Nvidia it's 32. The Tesla also has quite a high PE ratio of 46, and the forward PE ratio actually is 62. The smallest PE ratios, so the best PE ratios currently, are for Google. The Google had a very bad launch of their artificial intelligence. They actually worked for longer on their AI product than, for instance, Microsoft, but Microsoft spent a lot of money and bought into the OpenAI, so the ChatGPT project, and that helped them improve their artificial intelligence part of their business. So Google coming with 24 PE, that's not such a high value compared to the broad S&P 500 index. Currently, in the March of 2024, the PE ratio for S&P 500 is around 27, so it's actually a little bit less. Google also has a lot of cash on their balance sheet, so they have a lot of funds that they can spend in order to invest and in order to grow their business. The PE ratio of Apple is not also that high compared to the index. It's 28. Warren Buffett, for instance, is a big shareholder of Apple, but he bought it at a much lower price compared to the current PE ratios. And Meta from Facebook also has a lower PE of 32. It's not as low as PE as we could find it during the stock market. I wouldn't call it a crash, but it really went down 75% in recent years. So you could grab Meta when the PE ratio was half of that, when the PE ratio was around 15. So it's still maybe not the worst compared to the other companies, but a lot of the growth is expected from the VR, coming from the VR, from the metaverse, and that's just a prediction of the future. We don't know if the earnings that will come from that will be big or will there be small and not significant for the business. In reality though, we shouldn't be talking about Magnificent Seven, because the majority of the growth comes from Nvidia, Meta, and Amazon actually. The companies like Tesla, Apple, Google, and Microsoft didn't outperform the market so much. Then here I'm talking about a very short period of time, starting at the beginning of 2024, where the Nvidia, Meta, and Amazon really outperformed the market and outperformed the other companies from the Magnificent Seven. So if you are a short-term trader, a speculator, investing in those companies with high PE ratios like Amazon and Nvidia might bring you benefits. But if you are trying to be a long-term investor, and if you are looking for a good businesses to invest in, remember that even the best business bought at very high price compared, for instance, to its earnings or book value will bring you bad results in the long term. Because in the long term, the price of the stock will reflect the real value of the business, and your profit from the investment will be correlated to the amount of cash produced by that business discounted to the present value.